Good evening, ladies and gentlemen. Pleasure to be here. Alternative investments is a subject that's close to my heart. This presentation, like anyone, should work like a Rolls-Royce, which means it should go without any hiccups, repairs, or technical problems, which is guaranteed because only Werner, I think, can interrupt me. And it should also go on forever. So if you stock up on food and dinner and things you need for the next 3 to 4 hours, then that would be good. Joke aside, if you have a few Red Bull cans around, that would help too. It keeps you awake. I'm going to present for about 30 minutes. I'll keep that relatively paced so that there's always something interesting. Having watched the US election overnight, I have to say that I'm reinforced in the fact that when I say something, I would like to have some evidence. So you will see some graphs. Don't worry about the graphs. If you take the message, you get the presentation, you can check that, and you can see other graphs. But we have to put some fundamentals into this presentation. So let's get rolling. The agenda is the ongoing challenges of investing, and I've oriented that a little bit towards retail investing, but the examples, of course, are generally from institutional investing. We then have the world of alternatives, primary alternative assets, then secondary alternative assets, and then we have some practical considerations, because after you will be totally exhausted, you will want to know, well, so what can you do with all that, except looking at the presentation. Let's get rolling. Traditional asset classes and traditional portfolios, the challenges, quo vadis in these times. For those who haven't had Latin, it means where are we going in these days? Time-worn assets. The classic assets are public stocks and shares, listed and rated bonds, cash, money market and foreign exchange, and family property. That is not the classic view, but I have included family property because I think that most people have their family property, could be a second home, their main home, as part of their traditional assets. And most people also, because we live abroad, will consider currencies as their main asset because they live in a different country than their home country. So they'll probably hold currency exposure. The resulting portfolios, and here you see a graph, and I will just take you quickly through. On the left-hand side, you have individual investors. You have the proportion of assets in a classic portfolio. At the bottom, you have 1987 to 2017. There's a 30-year time horizon. And you can see the black line are stocks, the red line is cash, and the blue lines is bonds. And you can see over time, every time you take one slice, how the proportion of the portfolio has changed. Shares have moved from about 45% to close to 80%. And cash has moved from 35% to about 40%, down to 20%. And bonds have been relatively of all constant at about 20%. That is the classic portfolio of a retail, and the reason it's classic is because everybody was greedy on the stock market. If you look at the right hand, those are the fund managers. They are a little bit different because they were not that greedy on the stock market, although they also turned greedy. They were a lot more heavily invested in money market and then in bonds. The upshot of these two graphs is that the portfolio composition changes constantly. Now, there are two reasons. One of them is because they want to change it, but the second one is something called drift. If you think that you have $1 in bonds and $1 in shares, and the bond keeps the price, and the share market doubles without doing anything, you suddenly have 1/3 in bonds and 2/3 in shares. And that actually happened before the financial crisis, the various financial crises. shares just outpace everything else. Now, this, of course, leads to risks. On the left-hand graph, we have the bonds, US Treasury. Everybody says US Treasuries have no risks. Well, look at the graph. Even if I don't explain the graph, you can see the volatility. This graph is the 10-year Treasury maturity minus the 3-year maturity. And the reason is you want to eliminate short-term movements in the market. And you can see that over a period of the same 30 years or almost 30 years, this has moved like a yo-yo. That is called volatility. And in the simplest terms, volatility equals risk. Not precisely and not academically, but in the simplest terms. If you look at the US stock market shocks, you have 4 lines. Those were the 4 major crises or 4 major crises. The yellow one is 2020, what we're living today. This is and the X is in the number of days to hit rock bottom. This was the shortest path to losing 30% of the value. The second was 1987, when it took about double the amount of time. The third one, as by comparison, 1929, when it took about 1.5 months. And if you look at the top line, which is the great financial crisis, it didn't happen that fast. It actually took several months to hit rock bottom. What this chart shows you is that when a crisis hits, it hits fast, it hits hard, and you are defenseless against that. Where should we turn in that? Well, I like to look at long-term trends. This graph shows you the past 30 years from 1985 to 2014, and that is the gray column. Then it shows you the next 20 years, that is the yellow column. And for a measure of entertainment, the dotted line is the average for the last 100 years. So here you can see that US equities in 30 years, on average, returned 8% per year, which is pretty sexy. It is projected, depending on a high growth or a low growth scenario, to reduce to 6.5 or 4%. The 100-year average is 6%. European equities were about the same than US equities. It is not true that long-term European equities perform less well, they just perform differently. Here again, the next 20 years, 4.5 to 6%, depending on high or low growth scenario. And again, the 100-year average was lower. So over the 100 years, Europe in fact performed less. This has to do that America over the last 100 years simply developed faster than almost any economy on the globe. If you look at bonds, they were 5% over 30 years. That's very good. They're coming down to 2%, and that is going to be reduced to 1% if the central banks keep their policy. European bonds are a little bit higher. Europe tends to pay a little bit more, again to 2%. You can reduce that to 1%, if not 0.5%, and over 100 years, you got 1.6. So if you're looking at your own portfolio and your investments, and you're expecting maybe 4% on equities, maybe 1.5% on bonds, then this is not very good fun, because we are going to have some inflation. And that is the real problem we have to deal with. It raises the challenges. And the reason is that the intelligent investor, and I assume that all of you are intelligent investors, number one, allocates assets strategically and avoids hunting returns at all costs. Intelligent investors don't jump on something they think is going to be the next winner. Investing is a long-term game. As they say, 1-year investment is cash management. 3-year investment is speculating. 5 years and plus is actually making an investment. Secondly, the intelligent investor demands rewards for risks taken and avoids risks not rewarded. If you're holding an asset that has very high risk and you don't get paid, or you don't expect to get paid, you shouldn't hold that asset, because somebody else is making money on the risk you're holding. And the third thing is intelligent investors stay invested for longer periods and avoids frequent portfolio adjustments. The time factor is the single most important success factor other than asset allocation, which is choosing where you invest. Any 10 years longer invested almost doubles your returns against any market condition. So jumping around is quite attractive and it gives you something to talk about, but in fact, it doesn't do very much for your portfolio. So given that the world is turning against us, low returns, high risks, crisis all over the place, where do we turn? Well, there is the world of alternatives. Let's try and define the world of alternatives. There are different asset classes, there are differences, and there are arguments for changing guards, i.e. for moving into alternatives. You remember the left box is the old or the traditional assets, shares, stocks, bonds, cash, money market, family property. The primary alternatives are private equity, private debt, hedge funds, infrastructure, real estate, and natural resources. I need to explain why they are in different color. The ones that are in black are more of a variation of traditional assets. So private equity infrastructure also exists in traditional assets. The red ones are those which did not exist. Now you will say real estate always existed. Yes, but only in listed shares and not in direct investments in commercial or residential real estate for investment, as opposed to having private flat that you rent out. Natural resources have also been investments for traders. Natural resources are oil, gas, some of the commodities, but also farmland, forestry, and so on. But we're also not considered an asset class and not invested. And hedge funds are a category up to themselves that includes artificial intelligence and algorithmic trading, because in fact, they use a lot of the traditional assets, but they package them differently and they trade them differently. A real hedge fund is defined as a fund that is market neutral. Market neutral means it makes money when the market goes up as well as when the market goes down. Now, most of the hedge funds are not market neutral. That's also why they're special. Most of the hedge funds are so-called directional traders. They take a view on the market and then they punt the market. However, they are almost always protected against the downside. And they mainly do that by short selling or by taking contrarian positions. And then there are the secondary assets. There is ESG, which, as you know, stands for environmental, social, and governance investment. There are very recent crypto assets, and then there are private assets, and that's the fun part of the presentation. That is all the things that we collect and make money. And then there are esoterics. I'm not talking about esoterics, but I'll give you a few examples. They have to do with investing in litigation funds, in buying unexpired life insurance policies, in taking distressed assets and packaging them into securities. They tend to be very complicated and tend not to be suited for most normal people. Now, what is the difference? And that's really the most important thing, I think, for you to take home from this presentation. In traditional assets, you invest for future cash flows. Companies on the stock market are valued at future cash flows. The value of a company is the net present value of the discounted future cash flows. This explains why a company that makes 100 million can be valued at 10 billion, because the expected future cash flows are that high. And that's a classic case of the high-tech companies. What you get for that is monetary rewards and some few returns, and a few rewards. The monetary returns are typically dividends, They also are price increases, called market returns, and sometimes you get a few rewards. I remember, since most of you are Austrian, Julius Meindl in the old days gave every shareholder a basket with goodies. So of course, when we worked for the bank, we all bought Julius Meindl shares. We walked to the General Assembly and we all got a basket of goodies. But nowadays, generally, companies do not give you rewards. They actually concentrate on financial returns. Because of that, you have high volatility at any time. Look at the airline industry. You could have a coronavirus, and suddenly the airline industry is unable to pay any dividends, let alone salaries or anything else. You have high liquidity because there are many buyers, many shareholders, and most of your risks, or not all of them, are exogenous. Classic case, the coronavirus, global financial crisis, and the various other crises. The success factor in traditional assets is timing and discipline. If you get in at the right time, you stay long enough, that is a discipline element, you always reap a reward unless you have chosen a company that goes bankrupt. That, of course, requires a little bit of knowledge. Now, alternative assets are different. You invest primarily for future asset values. Because you're not investing for cash flows, you only have ongoing rewards, no returns. Now, ongoing rewards, if you invest in a classic sports car, you can drive around and you have fun for your life. If you buy a valuable painting, you can put it on the wall and you enjoy it. If you invest in wines, the increase in value will allow you to drink half of the wines and still make money. Those are rewards, but they are not returns. Sometimes in alternative assets, such as private equity, you also get returns, but even so in private equity, it takes time for the companies to materialize. So generally, returns take much longer and they're less. Because of that, you have lower volatility in the pricing, you have less liquidity, and you have the risks in the value, not in the external one. If you look at the coronavirus, then the coronavirus has hard hit a number of shares and stocks, but it has not equally hardly hit some of the alternative assets because they depend less on these factors. What is required is expertise. You have to know what these assets are all about, and patience. This is more oriented towards longer-term investors, i.e. the true investor. If you want to be trading, or if you want to play around in markets, currencies, commodities, it's very easy. You register with a platform, you buy yourself a book, or you take a course, and then you start counting your money. On average, you will do okay if you are disciplined, above discipline, you take a strategy and you keep it. And in fact, if you hire a monkey, the famous Montiel monkey, Montiel, great economist, who demonstrated that if the monkey throws darts at a spreadsheet, he probably makes equally good investments than a fund manager. So on average, you might actually do reasonably well. Long term, you will probably not do well. Now, why would we even look at alternatives? Because they have better risk-return trade-offs. I gave you two examples and then a caveat. On the left hand, you will see a portfolio over 10 years, one that has 20% alternative assets and 80% traditional balanced portfolio, which typically is 60% stocks, 40% bonds. And on the blue box, you only have 60% equity and 40% fixed income. Now you can see in terms of return, they are about similar. You have to look at the horizontal line, roughly similar. The one with alternative, a little bit higher. But if you look at the horizontal axis and you look at the standard deviation, which is a measure for volatility, you can see that there is a quantum difference between the risk of the blue portfolio versus the yellow portfolio. So the yellow portfolio makes better returns and it has a lower risk. Another example, over a longer period, on the right-hand side, from 2000, 1/1/2000, those are arbitrary dates, to 31/12/2018. Again, a portfolio, as you can see the composition in the pie chart. I have to make a comment. Since I steal all the data, I steal the pictures, and so I don't do them in the right color scheme and I don't replicate them because sometimes they don't provide the data, so you have to forgive. But I quote everybody, and in my disclaimer, I said that's no copyright infringement. This is actually allowable for education purposes. So if I look at this portfolio, which before was similar, 40% was 40% stock and 60% bonds, so a more conservative portfolio, the annualized return was 5.15%. The Sharpe ratio, which is the return earned in excess of risk-free against volatility, was about 0.42. The standard deviation, again, the risk, a measure for the risk was that. And for a $100,000 investment, you got $260,000 back. With alternatives, you made, again, a slightly higher return. The Sharpe ratio is slightly higher, which is good. Optimally, the Sharpe ratio should be 1 or above, because that means that the return you earn covers all the volatility and the risk-free rate. So if you see something 1, that's wonderful. Your standard deviation is lower, your risk is lower, and lo and behold, your 100,000 made $276,000 over 10 years. Now that is not a big difference. This is not a big difference. The point is that it does something to your portfolio. If you choose a higher proportion of alternatives, or you choose higher performing alternatives, these numbers could become very significant, and we'll see that later. Now, there's a caveat. Selected studies show an inverse effect, in particular because of high fees. Alternative assets have very high fees, and they take away between 1 and 2.5% of your return. Now, if you look at the difference here, you have 35 basis points, 100 basis points being 1% difference. So if you are paying 150 to 250 points to the fund manager, this reverses completely. That is a problem, and we'll also get to that. And then passive investments, i.e. low-cost investments, where you do not pay a fund manager, may achieve a better risk-reward ratio in bull markets. And there are dozens of studies on that, and it is not clear because everybody uses different metrics, different comparisons, different portfolio compositions, different timeframes. It becomes difficult. My view, however, is there is significant evidence that you do better with alternative assets. Sorry, I went not yet. I pressed the wrong button. What happens at my age? Now, I like to ask ultra high net worth individuals, so-called UHNWI. Those are people with more than, I think, $50 million in financial assets. Everybody defines them differently. And I look at their asset allocation in 2020 for the next 5 years. And here you can see it. Again, I had to copy the picture because I had to steal the data. 27% is in property as an investment, i.e. not self-occupied, not for short-term income generation by renting out, but for investment. 23% are in equities, 17% are in bonds. You see the proportion between equities and bonds has over 100 years been always between 40-60, 60-40 roughly. 11% in cash and currencies, 8% in private equity, 5% in collectibles, 3% in gold and precious metals and jewelry. Ladies, you would be happy. And 1% in crypto assets. So if I look at the total thing, only about 60% in this model are in the traditional assets. The rest is actually in alternatives. Now, you could argue that property is not entirely alternative. It has always been there, and I grant that. So I will say the new model is 30 to 45% in alternatives if and only if you are an ultra high net worth individual and therefore have a lot of money, have patience, and do not rely on the money. So let's not confuse that with somebody who desperately needs a cash flow. But it shows you where the world is moving. Now let's look at the alternatives individually. The primary ones, remember, private equity, private debt, hedge funds, infrastructure, real estate, natural resources. Now, a few words. Private debt is actually lending as an individual to other individual companies. One of the bigger markets that you can access easily is called peer-to-peer lending. There is even one in the UAE where you can give a certain amount of money. They will do the credit and they will pay you 8% return for lending. It also has to do with lending people to pay for their, as I said before, for their life insurance policy. Some people have a policy that is with investment. They have to break it after 10 years. That's very expensive. You lend them the money and you buy the policy. It is also to do with microfinance, where you lend through companies in very small quantities directly to individuals. It is also you buy notes from companies, IOUs from companies as a lender. Hedge funds, we briefly talked about that. Infrastructure are investments in airports, roads, toll bridges, and related infrastructure. Real estate is the investment in real estate. Now, the real estate market is huge globally, but most of it is actually held by real estate companies and or by private individuals and was not available for alternative investments. Natural resources, we said land, timberland, farmland, forestry, oil and gas, mining rights, and so on. There is a strong growth. Very quickly, don't worry too much about the graph. From 2004 to 2020, the market for private equity, real estate, and hedge funds, and FOF is fund of funds, has moved from 2.5 trillion to about 15 trillion. That is a whopping growth rate on the high case, or about 13.6 on the base case. In fact, these numbers are already outdated because that was done 1 or 2 years ago. So there is significant growth. There is a decent performance. If you look at here on the left-hand scale, you have the return net of fees, and then you have the 5 asset classes: private equity, private debt, real estate, infrastructure, and natural resources. Here you have them labeled. The blue one, private debt, consistently oscillates around 10% because on average you get 7 to 8% return, sometimes 9%, 0.5% fees. It's pretty constant, almost zero volatility. Real estate, infrastructure, and private equity are very closely bunched around 12, 13%, a little bit more volatility, in particular in the aftermath of the financial crisis, 2008, where these things went up, were very attractive. And then you have natural resources, which actually in recent years has proven to be very attractive. Now, the numbers only go to 2015. If I had to project them, and I don't have the data because it's pretty difficult to get to the data, then I would expect, or I know, that the numbers are not radically different. Natural resources coming down, private equity is going up a little bit, and real estate is remaining rather constant. You can assume that there is no huge difference. Now, they also provide relative value. If I now look at of August 2018, 5 years forward, as projected by Aberdeen Standard Investments, and here you have the expected return on the left side. On the right, on the horizontal line, you have volatility, again, a risk measure. Then these blue ones are bonds, they call them rates. And you can see there is a moderate risk, but there is very moderate return. The yellow ones, those are the sexy ones. They have higher risk than bonds, but much higher returns. And equities have similar returns, a little bit lower and much higher risk. And in between, the gray ones are the credit. They are a little bit like alternatives, but it depends on what you have. So what you have here, you can see that over the next 5 years, expected returns, alternatives beat everything. Now, the way to read this graph is that you want to have higher returns for the same risk, or for the same return, lower risks. So you take a line here, say 13, and you look at the highest return for that risk. And you find, say, or here, 12, emerging market local debt. So you always compare in these lines. Or you say, I want to achieve 6% return. You look at the 6% line, and you look at those with the lowest risk. And here you have an alternative, which is renewables infrastructure. That's also something that is very big in infrastructure. Solar farms, wind farms, and so on, that also didn't exist before. So we have relative value because relative to each other, they provide value. And there's investor attraction. Very simple, because I have to hurry. The dark blue says they want to increase. The light blue says stay the same. And you can see that overwhelmingly people increase or stay the same in private equity, venture capital, private debt, hedge funds, real estate, infrastructure. Venture capital being a subform of private equity, it tends to be in startup companies, younger companies, smaller companies, and lower investment. But otherwise, it's very simpler. The risk is much higher, but the returns tend also to be higher. Now let's look at the secondary ones, because they're close to my heart and they're really good fun. ESG assets. Those are assets which comply with strict rules of environmental, social, and governance guidance. There are United Nations goals, there are regulatory goals, there are rating agencies who have goals. It is very clearly defined when you are ESG compliant. And the first stage is that you stop buying alcoholic firms, not sure why as an Austrian, but in any case. You don't buy pornography, understand why. You don't buy weapons, understand why too. So you avoid the really bad things. And the pinnacle of ESG is you do impact investing, which is you only invest for the purpose of improving the social and economic welfare of other people. And as a result, you make money, as opposed to the traditional investment where you aim to make money, and as a result, you might do some good things. Now, people underestimate the size, particularly Europeans. At the moment, sustainable assets that are defined as being good for the world, the environment, the economy, the social, everything, are 30 trillion. That is very significant. The largest share is Europe. Europe leads the pack. It is only 1 to 2% of global financial assets, but it is growing very fast. Fund managers use that to secure alpha, alpha being better than the others, and reduce risks. I'll give you 2 examples. In the last month, 2 companies were fined in the region of $8 billion for violating good corporate governance. One is a pharmaceutical, one is a bank. The bank is Goldman Sachs, as you know, the Malaysian scandal. So reducing risks at that level makes a difference, and alpha, we'll see in a second why that comes. We in Europe, we created a green exchange, one of the first one in Luxembourg. It has 37,000 green securities from over 100 jurisdictions, 2,500 issuers, listings in 50 currencies. If you want to invest in green, there is really a lot of material available, and you can buy it directly through a broker. So there's no excuse of not investing in ESG. Now, why is there an alpha? There is, and you will see it here, a study, it's so-called a meta study, that summarized over 2,000 other studies to come to an overall conclusion. So if you want to have solidity in data, then that is the case. Over 2,000 studies is a lot. And they said, We clearly find evidence for the business case of ESG investing. ESG outperformers exist in many areas: North America, emerging markets, and in non-equity asset classes. Now, what's the data? Positive outperformance over half of all 2,000 studies, and they have millions of data points, found positive. Only 6 to 10%, depending on which type of study was conducted, was negative. A quarter was neutral, neither here nor there, and then a little bit was mixed. To give you an example, about 10 days ago, the SURE bonds of the European Community came to the market. Those are bonds to pay for unemployment, generating work, and most of you will know that. They issued 10-year and 20-year bonds. And the pricing on the 10-year bonds was 36 points over the 0% bonds. So instead of Bunds, which are the German government debt, so instead of getting nothing for German government debt, you got a higher rated bond and you got at least 0.4%. But the 20-year was 51 basis points over the 4.75 bonds. So today, if you bought that, you're getting over 5% in one of the highest rated bonds for the next 20 years. So if you make a financial plan, then that's a good idea. Of course, the value of the bond will decline if interest rates rise. But if you can live on 5%, then that's a pretty good investment. Now, to give you an idea, the total number of orders from institutions and private investors was 233 billion. The size of the bond was only 80 billion. It was heavily oversubscribed. And you can see how much money is available in slightly better performing ESG assets. Very attractive space. Now let's look at crypto assets. Crypto assets cover index tracking. Believe it or not, many of the crypto assets have indices. The infrastructure for the indices, those are generally service providers. The venture capital that invests in crypto type and blockchain related assets. Blockchain related listed companies. The trading of coins and lending. And this is just a structure. It is not equally weighted. Now, there are several funds. I took one of the funds and I looked at their performance. Well, in 2018, they didn't do very well. They lost 56%. In 2019, they did 11%. In up to date 2020, and that is end of September, they were close to 50%. So they caught up their losses. Now, if you look at the risk from 2017 to 2020, then they had a deviation of 44%. Remember, Sharpe ratio 1. If I have 44%, I want at least to make 44%. I made 48%. That's good news. Their downside deviation, the downside risk, because as you know, deviation is upside and downside because you have to take the square root of a number and that makes plus and minus the same. So there's no plus and minus, is only 20. So your downside risk is 20%. The upside was 37%. Those are the good news. The maximum drawdown was 57%, not for the faint-hearted. And the worst monthly return was minus 20. So that gives you an idea of the riskiness, but also the return in crypto assets. If you look at Bitcoin, if you went in at a decent time, you would actually be very well performing. Now, the greatest fun are the private assets, and I will be finished in a few minutes. I will take you through this wheel from north moving to the right. Wine, one of my favorite. This number, the external number, shows you the return over 10 years. Fine wines made 120% over 10 years, i.e. they more than doubled your money. Actually, much more than that. Last year, this number, they made 1%. Furniture, classic furniture, Baroque furniture, French furniture, Chinese furniture, made minus 27% over 10 years and nothing last year. Colored diamonds made 77% in 10 years and minus 1% this year. The index overall, if you took everything together, was 141% up in 10 years and only 1% down this year, last year, 2019. Cars are one of the top performers. They made 194%. Niki Lauda's winning Ferrari, which is unique, made millions of dollars in the sale. So if you have unique classic cars, is whopping returns. Jewelry made -7, and we lost that here, but about 90% over the 10 years. Handbags, which I don't quite understand, Hermes bags made 108% and 12% this year. Stamps, 64%. Art, 104%, exactly the index. Rare whiskey shot the moon, made 564%. If you buy a few bottles of good rare whiskey and you hold it for 4 or 5 years, you can make a killing. Coins made 175%, very liquid market, and watches 60%. Now, were they risky? No, they were not risky. Here you see the various categories, and here you see the volatility. The average index, you bought one watch and one jeweler for your wife and something, had about a 5% volatility, and as we saw, 141% return over 10 years. If you look at jewelry, even less volatility. Chinese ceramics, low volatility. Watches, low volatility. Furniture, low volatility. Private collectibles, low volatility. Colored diamonds, up to cars, which had 10% volatility, still less than the FTSE, that is the UK index, and much less than gold, which everybody thinks is a safe haven. 2 more minutes. So practical applications. What are the challenges? Well, everybody says, I don't have access. How do I get to that? And I will tell you how. People say, I have no way of measuring the value. That is true. You need an expert. If you have a rare sports car, then you really don't know what the market pays. You might be surprised. Or even a piece of Art Deco in your home. I discovered a lamp that was signed by somebody worth 20,000 euro, which everybody in the family thought was actually junk. So you can find something, but you need an expert. Liquidity, you need to accept longer holding periods, which in any case is good for the intelligent investor. And there are more complex exit steps. You may not be able to sell it by one telephone call. And the cost, there is maybe a larger initial investment and higher fees. So what do we do about that? Because we want to buy assets. Well, the retail access today has been facilitated. In financial assets, those are contracts as opposed to real assets. You have non-traditional equity and fixed income securities that do the trick. For example, the Sure bond I talked about from the European Union. For example, 37,000 green bonds that are listed. You have mutual funds that invest very specifically and purpose-driven in something that you like, even in diamonds, in art, in cars, in anything. If you want to save money, you have ETFs, which are exchange-traded funds. They come with a fraction of the cost. They are very low cost. And they invest often in strategies or indices, so you don't have great risk. Special purpose securities, people issue securities for exactly alternative investments or other currencies. In real assets, you have the specialized trade. Jewelry, of course, is your trusted jeweler. Cars may be your trader. Coins may be your trader. And you have mutual funds, you have ETFs, you have special purpose securities, and you have auctions and private markets. The wine market, for example, has a separate market. It's for professionals only. But they list about 20,000 different wines with bid and offer, and you can find a buyer for almost any wine that is investable. At auction, you can buy the whiskey, you can buy the cars, you can buy all this stuff. So it is not impossible. You have to do a bit of research. So my last slide. One before last. What are the avenues? I can't tell you the products because I'm not allowed to do that. That would be investment advice. I can tell you the categories. In private equity, you can buy shares. You can buy listed shares of the largest private equity player, KKR, and you can check that. And it's like buying a share, you're just in private equity. You can buy mutual funds and you can buy ETFs. You can also buy feeder funds, which are funds that collect retail money to create a big amount of money and then become an institutional investor. Expensive, but possible. Private debt, you have shares and internet. You can go to a peer-to-peer lender, you can send the money there, and they will lend out the money and they will pay you a return. You can buy shares in microfinance. You can buy shares in companies that do private lending. There are also mutual funds. We have a mutual fund in South Africa that only lends to teachers and policemen private loans, makes very stable return. None of these people want to lose their job, and you can get into that. Hedge funds, they are now exist as mutual funds, and they also exist as ETFs. Infrastructure, real estate, and natural resources, you can get into listed companies, so click away, into mutual funds and into ETFs. ESG assets, you have the public markets for all sorts of things and ETFs. Crypto assets, you have brokers, the internet and mutual funds, and private assets, as I said, auctions, the trade, mutual funds, and market exchanges. So for every of the category, there is retail access. Now, what should you do next step? Please take expert or investment advice, because some of the things of the assets are more complicated. Research on the internet, get informed. Just for getting the data for this presentation and have anything, I learned a lot of things. You can easily find, click in best performing alternative asset mutual fund or ETF, and you will have a list of 10 major fund managers, and you can see how they're doing. Just get informed. Find a good broker or independent financial advisor, because you need a platform to execute a trade. Integrate the longer time horizon and the asymmetric cash flows into your financial plan, because you don't want to be caught left-footed to have a good investment but be a distressed seller. Negotiate fees with all parties. Yes, the fees are high, but you can always negotiate. Thank you and good fortunes.